Every country that has ever built roads, funded armies, survived depressions, or rebuilt after disaster has done the same thing at some point. It borrowed money it did not yet have. For most of American history, that borrowing was treated as background noise, a routine tool of government rather than a national emergency. But something has shifted in the last few years, and the shift is big enough that even people who never followed economics are starting to feel it in their bones. As of the middle of 2026, the total gross national debt of the United States has crossed $39 trillion, and it is still climbing at a pace of roughly $8 billion a day, which works out to more than $90,000 every single second. Divide that number across every household in the country, and each one is now carrying close to $290,000 of federal debt on its shoulders, whether it knows it or not. The number has become so large that it has stopped functioning as a number in most people's minds and started functioning more like a rumor, something you hear about on the news, shrug at, and move on from. That reaction is understandable, but it is also exactly the reaction that keeps most people from noticing how this trend actually touches their lives. Picture a couple living in a mid-sized American city, somewhere with good schools and a modest cost of living, the kind of place nobody thinks of as ground zero for a financial story. Call them Rachel and Tom. Rachel teaches middle school science. Tom repairs HVAC systems for a small local company. They are not wealthy, they are not struggling, they are simply in the middle, raising 2 kids, paying off a car, slowly chipping away at a mortgage. They signed a few years back at a rate that already feels painfully high compared to what their parents got decades earlier. Neither of them thinks about the national debt while packing school lunches or fixing a furnace on a Tuesday afternoon. But the national debt thinks about them in the sense that the decisions being made in Washington about borrowing and spending are quietly rewriting the financial conditions Rachel and Tom live inside of, whether they ever open a newspaper or not. The story usually starts the same way it always has. The federal government spends more in a year than it collects in taxes. And to cover that difference, the Treasury issues bonds, bills, and notes that investors buy in exchange for a promise of repayment with interest. Pension funds buy them. Insurance companies buy them. Foreign governments buy them. Everyday savers buy them inside retirement accounts without even realizing it. For decades, the system worked so smoothly that people barely thought about it because the interest owed on all that borrowing was manageable, and the economy kept growing fast enough to make the debt feel proportionate. That is no longer quite the picture. The average interest rate the government now pays across its marketable debt has climbed above 3.3%, more than double what it was 5 years ago. And because the pile of debt underneath that rate is so much bigger than it used to be, the actual dollar cost of simply servicing the debt has exploded. Net interest payments are expected to cross $1 trillion in this fiscal year alone, nearly triple what the government was paying in interest just 5 years earlier. To put that in perspective, in the first months of this fiscal year, interest payments on the debt actually exceeded the entire budget for national defense, a milestone that used to be almost unthinkable for a global superpower, and has now happened for 2 years running. Tom would understand this instinctively if you framed it as a mortgage. Imagine refinancing your house at a much higher rate than you originally signed for, except you are not shrinking the loan, you are adding to the principal every single month while the new higher rate applies to the whole growing balance. That is roughly what has been happening at the federal level. The government is not just carrying old debt forward, it is layering new borrowing costs on top of a debt pile that itself keeps growing, because the country continues running deficits north of 5% of the entire economy every year. According to the Congressional Budget Office, the deficit for this fiscal year alone is projected near $1.9 trillion. And over the coming decade, cumulative deficits are projected to add over $20 trillion more, pushing the debt held by the public toward 120% of the size of the entire American economy by the mid-2030s, a level the country has never sustained in its history, not even during the Second World War. If current policy continues unchanged for 30 years, the same projections show debt climbing toward 175% of GDP by the middle of the century, with annual interest costs alone consuming somewhere around 7% of everything the economy produces in a given year. Rachel, being a science teacher, likes to think in terms of feedback loops, and this is exactly the kind of feedback loop that worries budget analysts. The bigger the debt gets, the more interest has to be paid on it. The more interest that has to be paid, the less room there is in the budget for anything else, which forces more borrowing to cover the gap, which then makes the debt even bigger, which then requires even more interest. Economists sometimes describe this as a snowball rolling downhill, gathering size and speed with every rotation, and the danger is not that any single year looks catastrophic, but that the trajectory compounds quietly until the compounding itself becomes the crisis. Interest costs are now the second largest line item in the federal budget in many recent months, trailing only Social Security. And by some CBO estimates, interest will become the single largest category of federal spending within the coming decades, if nothing changes, larger than defense, larger than Medicare, larger than every discretionary program combined. This is where the story stops being abstract for a family like Rachel and Tom's. When the government borrows on this scale, it is competing with everyone else in the country for the same pool of available savings and investment capital. Economists call this crowding out, and the mechanism is fairly intuitive once you see it. There's only so much money available to be lent out at any given moment, and when the federal government shows up wanting to borrow trillions of it, that added demand tends to push interest rates higher across the board, not just for government bonds, but for everyone trying to borrow, including families buying homes and small business owners trying to expand. Analysts have calculated that a jump of just over half a percentage point in Treasury yields, driven partly by growing federal borrowing needs, can add close to $200 a month to the payment on a typical $500,000 mortgage, and tens of thousands of dollars over the life of the loan. For a family financing a home near $1 million, the added lifetime cost from that kind of rate increase runs well over $100,000. Meanwhile, would-be homebuyers who might have qualified for a mortgage at a lower rate are increasingly failing to clear the underwriting threshold entirely once rates climb, not because their income changed, but because the math around what a lender considers affordable shifted underneath them. Tom sees this literally in his own line of work, watching customers put off replacing an aging furnace or delay financing a larger renovation because a loan that once felt reasonable now carries a noticeably heavier monthly bite. There's a version of this story that treats debt as an unambiguous villain, and there's another version, just as common among economists, that treats debt as a completely normal and even useful tool depending on how it is used. Both versions contain some truth, and the honest picture sits somewhere between them. Borrowing to fund a war, respond to a pandemic, or invest in infrastructure that raises future productivity can pay for itself many times over if the economy grows faster than the debt used to finance it. The problem emerging in the current environment is that a large and growing share of federal borrowing is not funding investment at all. It is funding the gap between ongoing government operations and the interest owed on debt already accumulated. When Rachel asks her students to imagine a household that keeps opening new credit cards just to make the minimum payments on old ones, most 12-year-olds immediately grasp why that pattern eventually becomes unsustainable, even if they cannot yet do the math behind it. What has changed the tone of the entire conversation over the last year is that the institutions whose job is to judge exactly this kind of risk have started saying so out loud. In May of last year, Moody's became the final one of the 3 major credit rating agencies to strip the United States of its very top credit rating, downgrading the country from its highest tier to the next rung down and citing, in plain language, the failure of successive administrations and Congresses to reverse the trend of large annual deficits and rising interest costs. That downgrade brought Moody's in line with Standard & Poor's, which had made a similar move back in 2011, and Fitch, which followed suit in 2023. For the first time in modern history, all 3 of the major agencies that grade sovereign creditworthiness agree that the United States no longer deserves a flawless rating. None of them are predicting imminent default, and it is worth being clear about that, because the language used by analysts covering the downgrade consistently emphasized that this is not an urgent alarm bell so much as a warning about direction. But the direction itself is the message. As one strategist quoted at the time put it, the deficit is not a problem until investors start believing it is a problem, and ratings downgrades are one of the clearest early signs that the belief is starting to shift. There's a reason the United States has been able to run these deficits for so long without the kind of crisis that has hit smaller countries carrying comparable debt loads, and that reason is the dollar. The American dollar remains the world's dominant reserve currency, used in roughly 89% of global foreign exchange transactions, and held in a majority of central bank reserves worldwide. That status gives the United States what economists have long called an exorbitant privilege, the ability to borrow enormous sums in its own currency at relatively favorable rates, because the rest of the world simply needs dollars and dollar-denominated assets to run global trade and finance. Foreign investors currently hold somewhere around $9.5 trillion of U.S. Treasury securities, with Japan as the single largest foreign holder at roughly $1.2 trillion, followed by the United Kingdom near $900 billion, with China holding a shrinking but still meaningful position of under $700 billion after years of gradually reducing its exposure. That steady global appetite for American debt is precisely what has allowed the country to keep financing its deficits without the kind of borrowing cost spiral that has forced painful austerity on other heavily indebted nations. But that privilege is not a permanent law of physics, and there are real signs it is being tested. The dollar's share of global foreign exchange reserves has slipped below 57%, the lowest level since the mid-1990s, as central banks in various parts of the world diversify into gold, into the euro, and increasingly into arrangements that let them settle trade in local currencies rather than dollars. Gold's share of global reserves has roughly doubled over the past decade as central banks, especially in China, Russia, and a handful of other economies, buy bullion as a politically neutral store of value that cannot be frozen or sanctioned the way dollar assets can be. None of the mainstream analysis suggests the dollar is about to lose its reserve status outright. The alternatives are simply not deep or liquid enough to replace it in the near term. But nearly every serious voice covering the topic agrees on one underlying point, which is that the dollar's dominance is underwritten by confidence in American fiscal responsibility as much as by raw economic size, and that confidence is the one input policymakers actually control. This is the part of the story that connects most directly back to Rachel and Tom's kitchen table, because confidence is exactly the ingredient that keeps their own mortgage rate, their own car loan rate, and their own retirement account returns behaving the way they expect. If global investors ever concluded that America's mounting debt and growing interest bill made U.S. bonds meaningfully riskier, the compensation those investors would demand in the form of higher yields would ripple outward into every corner of the domestic economy, raising the cost of every loan tied even loosely to Treasury rates. That is not a hypothetical mechanism. It is the same mechanism already visible in the mortgage market today, just at an earlier and milder stage. There is another piece of this puzzle that rarely makes it into casual dinner table conversation, but matters enormously to a family planning for the future. And that is the looming shortfall in Social Security and Medicare. Under the most recent trustees report, the Social Security Retirement Trust Fund is now projected to run out of reserves by the end of 2032, at which point incoming payroll taxes would only be sufficient to cover roughly 78% of scheduled benefits, meaning an automatic across-the-board cut of around 22%, unless Congress acts before then. Medicare's Hospital Insurance Trust Fund faces a similar cliff roughly a year later. For a couple like Rachel and Tom, both in their 30s or 40s, that projected date sits uncomfortably close to their own retirement horizon, not far enough away to dismiss as somebody else's problem. The trust fund shortfalls are driven by the same underlying dynamic running through this entire story: an aging population drawing more out of these programs relative to the number of working age people paying into them, layered on top of a federal government that has less fiscal room to smooth over the transition because so much of its budget is already committed to interest payments on existing debt. It would be easy at this point to slide into pure doom, and plenty of commentary does exactly that, treating the debt trajectory as a countdown to inevitable collapse. But the more careful economic analysis, the kind coming out of institutions like the Congressional Budget Office, the Federal Reserve, and independent academic researchers, tends to resist that framing for a reason that is worth taking seriously. Debt by itself is neither good nor catastrophic. What matters is the relationship between the size of the debt and the size of the economy generating the income to service it. A growing, innovative economy can carry a larger debt burden than a stagnant one, the same way a household with a rising income can comfortably service a mortgage that would crush a household whose income is flat. There is a real argument made by serious people that productivity gains from new technology, including artificial intelligence, could meaningfully improve the growth side of this equation over the coming decade, and CBO's own projections already build in a modest boost to productivity from exactly that source. If economic growth outpaces the growth of the debt, even a very large debt becomes proportionally more manageable over time, the same way a business that borrows heavily to expand can end up in a stronger position 5 years later if the expansion pays off. The trouble is that right now, under current law and current trends, growth is not outpacing the debt. Interest is compounding faster than the economy is expanding, and the gap between what the government collects in revenue and what it commits to spend keeps widening rather than narrowing. Total federal spending is on a path to rise from roughly 23% of the economy today to nearly 28% by the middle of the century, driven overwhelmingly by three forces: Social Security, federal health care programs, and interest payments, while discretionary spending on everything else the public tends to think of as government, defense, education, transportation, research, gets squeezed into an ever-shrinking slice of the pie. Mandatory spending, the part of the budget that runs largely on autopilot regardless of what Congress decides in any given year, is projected to climb from about 75% of the federal budget today toward 80% within a decade, and higher still after that, leaving lawmakers with less and less real discretion over the nation's finances, even as the political pressure to do something about the debt keeps rising. None of this happens in a vacuum separate from ordinary political life either. Government shutdowns, once relatively rare, have become a recurring feature of the fiscal calendar, with a lapse in appropriations for parts of the federal government stretching across weeks in the past year alone, disrupting services and adding uncertainty even as the underlying deficit kept growing in the background, regardless of which agencies were technically open. Tariff policy has become tangled up in the debt conversation too. with new tariff revenue partially offsetting some of the deficit impact of recent tax legislation, though independent analysts are quick to note that the revenue generated so far falls well short of covering the scale of new borrowing being added elsewhere. Watching this unfold, it is tempting for someone like Tom to conclude that Washington simply cannot agree on anything, and in a narrow sense that is true, but the deeper pattern is that both parties, across multiple administrations, have contributed to the same trajectory, expanding some categories of spending, cutting some categories of revenue, and generally treating the debt as a problem to be managed later rather than solved now. One evening, in the kind of conversation that happens almost by accident at the dinner table, Rachel's older child, who has just started following the news a little on his own, asks her a simple, almost childlike question. If a family borrowed money to build something that made them more money every year, would that debt always be a bad thing? Rachel thinks about it and says, no, it depends entirely on whether the thing they built keeps paying off faster than the debt grows. Tom, listening in, adds that it also depends on whether you keep borrowing more just to cover the interest on what you already owe, because at some point that stops being investment and starts being a treadmill. Their son nods slowly, the way kids do when an idea clicks into place. And the conversation moves on to something else entirely, as dinner table conversations tend to do. But the exchange captures, almost by accident, the entire debate that economists, credit rating agencies, and members of Congress have been having in far more technical language for the better part of the last decade. The honest answer to where this leads is that nobody actually knows with certainty, and anyone claiming total confidence in either direction, whether predicting imminent collapse or waving away the risk entirely, is overstating what the evidence actually supports. What the data does show clearly is a set of trends moving in the same direction at the same time, a debt load approaching $40 trillion and climbing by roughly $1 trillion every 7 or 8 months. Interest costs that have already surpassed defense spending and are on track to become the single largest category in the federal budget within a generation. Credit rating agencies unanimously signaling reduced confidence in the country's fiscal trajectory for the first time in history. A dollar that remains dominant globally but is slowly losing ground at the margins, as other nations diversify their reserves. And entitlement programs relied upon by tens of millions of Americans heading toward automatic benefit cuts within the next decade absent legislative action. None of these trends by themselves spell disaster. Together, moving in the same direction at the same time, they describe a country with steadily shrinking fiscal room to maneuver, less capacity to respond generously to the next recession, the next pandemic, or the next unexpected crisis than it had 10 years ago, and even less than it will have 10 years from now if nothing changes. It helps to sit with the historical comparison for a moment, because it clarifies just how unusual the current moment actually is. The last time debt held by the public came close to today's levels relative to the size of the economy was in the years right after the Second World War, when the country had just financed a global war effort on an emergency footing. But that earlier peak came with an obvious explanation and an obvious endpoint. The war ended, spending fell sharply, and a booming post-war economy grew fast enough to shrink the debt burden relative to GDP for decades afterward almost automatically. There is no comparable one-time event driving today's numbers and no comparable natural endpoint in sight. Current projections actually show debt surpassing that post-war record within the next several years, and then continuing to climb rather than recede, which is precisely why budget analysts keep describing the current trajectory as historically unprecedented rather than merely elevated. One widely cited working paper by a historian at the Hoover Institution has even proposed something like a rule of thumb, arguing that any great power which sustains a period where it spends more on interest payments than on its military eventually sees its geopolitical rivals begin to test its position, pointing to earlier empires that crossed the same threshold before entering periods of relative decline. The author is careful to note that crossing this threshold is not an automatic death sentence. Britain crossed it more than once without losing its standing for decades, but he argues the only realistic way for the United States to climb back under that threshold without gutting its safety net programs outright is through a genuine and sustained productivity boom, the kind some economists hope artificial intelligence might eventually deliver, though nobody serious treats that as a guaranteed rescue rather than a hopeful possibility. It is also worth being honest about how differently people who study this professionally frame the danger. Some, including prominent voices in finance who have spent decades studying sovereign debt cycles, describe the risk in almost medical terms, warning of what one well-known investor called an economic heart attack, a moment where debt service costs suddenly consume so much of the budget that the government is forced into a jarring combination of tax increases, spending cuts, and money creation all at once, rattling markets in the process. Others, including senior figures at the Federal Reserve, have used gentler language, calling simply for what one described as an adult conversation among policymakers about the deficit before market pressure forces a less orderly reckoning. Still others, including some officials inside the current administration, have pushed back against the alarm altogether, arguing that measuring the debt only against GDP understates the true value of everything the country owns, its land, its institutions, its productive capacity, and that a wealthy nation with the world's reserve currency has more room to carry debt than the raw percentage figures suggest. All three of these perspectives get aired regularly in financial media, and Rachel and Tom, like most Americans, are left to sort through genuinely conflicting expert opinion rather than a single settled verdict, which is itself part of why the debt has become such a persistent and unresolved topic of public anxiety rather than a problem with an agreed upon fix. What nobody seriously disputes, regardless of which camp they fall into, is the sheer scale of money now moving through the interest line of the federal budget every single day. Treasury auctions still draw solid demand, with bid-to-cover ratios on recent note and bond sales holding comfortably above 2, a sign that global investors are still showing up to buy American debt in large volume even at today's higher rates. But every auction now also functions as a kind of ongoing referendum, a test of whether the world's appetite for financing American deficits remains as deep as it has been for the better part of a century. So far, it has. Foreign holdings of Treasury securities actually hit a fresh record above $9 trillion earlier this year, and demand from traditional allies in Europe and Asia has largely held up even as China and a handful of other nations have gradually trimmed their positions. Whether that appetite continues to hold as the debt keeps compounding is, in the end, the single question underneath almost every other question in this story, the one that determines whether the trajectory described by the CBO's projections plays out as a slow, manageable adjustment over decades or as something considerably more abrupt. For families like Rachel and Tom, the practical takeaway is not to panic, and it is not to ignore the subject either. It is to understand that the abstract-sounding headlines about trillions of dollars in federal debt eventually show up in very concrete places, in the interest rate quoted on their next mortgage refinance, in the return their retirement accounts generate as bond yields shift, in the size of the Social Security check they can actually count on decades from now, and in the political fights over spending and taxes that will only intensify as the arithmetic becomes harder to avoid. There is one more wrinkle worth sitting with before drawing any conclusions, and it involves the debt limit itself, the statutory cap Congress periodically has to raise or suspend before the Treasury runs out of room to keep borrowing under existing authority. What used to be a fairly routine, almost bureaucratic vote has turned into one of the most reliably tense moments on the political calendar, with the Treasury forced to deploy so-called extraordinary measures, essentially accounting maneuvers that buy extra weeks or months, while lawmakers negotiate right up against the deadline. Analysts at the CBO have repeatedly had to publish updated estimates of the exact week the government might exhaust its ability to pay all its obligations if the limit is not addressed in time. And while Congress has always acted before an actual default, the fact that the country now regularly flirts with the edge of that scenario is itself a symptom of how contentious the underlying spending and borrowing questions have become. Every one of these episodes adds a little more uncertainty into markets, a little more hesitation among investors who have to price in the small but non-zero chance that political dysfunction, rather than economic fundamentals, ends up being the actual trigger for a genuine crisis. The story of America's debt has never really been a story about a single terrifying number. It is a story about the widening gap between what the country spends and what it collects, about the slow compounding of interest on top of interest, about whether economic growth and innovation can outrun that compounding before the gap becomes unmanageable, and about whether the political system can summon the will to change course while there is still room to do so, gradually, rather than being forced into it suddenly by markets that lose patience all at once. That last part, the question of political will, has always been the hardest variable to forecast, harder than GDP growth, harder than interest rates, harder than any equation an economist can build, because it depends not on markets or models, but on choices that have not been made yet, choices that will fall to today's lawmakers and eventually to today's children. The same children asking simple, clear-eyed questions across the dinner table about whether borrowed money is always a bad idea, waiting, whether they know it or not, for the adults around them to actually answer.